Assets of stock. Assets of stock. Assets of set of stock. Good day, viewers. You're welcome to Web Educate. Today we are focusing on asset of stock. In our previous video we were still on asset of stock. Today also we were still on asset of stock, simply because asset of stock is one of the fundamentals under financial accounting that a beginner needs to understand very, very well. Without it, you not grab the understanding of the financial accounting very well. It's under double entry principle. We have covered double entry principle. So asset of stock is still under double entry principle. So today we are covering asset of stock, but the particular one we are covering is what is purchases of stock on credit on cash basis. Purchases of stock on credit or on cash basis. But before I start, let me remind us of what are the accounts entry that involve asset of stock. Like I always said, asset of stock accounting entry that we are going to make are sales account to purchases account 3 returns invoice account returns outwards account 5 carriage inwards account 6 carriage outwards account 7 cash account 8 bank account. So these are the what? Asset of stock. Why do we call it asset of stock? We call it asset of stock simply because they are the ordinary activities of the business. That is, they are the business that the business is dealing in. For example, if the business into the manufacture and sales of footwear or dresses, today we are going to sell dresses, we are going to sell footwear. That is the ordinary activity of what? Of the business. That is what we deal in. The business deal in this in. Do you see? That's why I call it asset of stock. And the accounting entry that we needed or that we need to make our what? Sales accounts, purchase accounts, return inwards accounts, return outwards accounts, carriage inwards accounts, carriage outward accounts, cash accounts, and bank accounts. Bank accounts. Sorry, I wrote accounts twice. So these are the assets of stock. Look at sales account. Why is it asset of stock? Simply because what turns into sales? That is stock. It's either we produce it or we buy it and resell. That is what the business is dealing in. That's why I call it asset of stock. Purchase account. Before, let me clear you on this. Sales account and purchases. They are the goods. That's why you're hearing goods costing so amount is sold, purchases, goods cost so amounts were bought. That is goods. Goods. What we call goods still what? Is still stock. They are called what? Goods. Goods bought, goods sold. That's for what? For sales account and purchase account. And they are the still one that is turned to what? Is turned to either return inward or return outward. You see the turn into a carriage inward, turn into carriage outward. You see what? If it's on cash basis, it's turned into what? Into cash account. If it's on it turn to cash account or turn to bank account. So, as I was saying, on sales account, it is what we are selling that is turned into what? Into sales. It's ordinary activity of the business. Purchase account, it is what we buy and sell, or what we produce and sell that we turn into what? Into purchases account. Return inwards, it is what we sell to our customers. Maybe some of them are bad or they are obsolete maybe for any other reason. It is the one that we turn into return inward that they return back into the firm. Return outward, it is the goods that we purchase from our suppliers that we will return back to them for any reason. Maybe damages or obsolete, or it is not according to specification, whatever reason. It is still what the goods that we bought that turn into return outward. Likely, carriage inward, carriage outward, it's still the same thing. That's called it asset of stock in the store. Asset of stock in our store. You get it now? So you must understand this very, very well. Let me give another scenario. Asset. You know, I always say from the beginning of when we started double entry that asset equal capital plus liability. Do you see? Asset equal what? Capital plus liability. You get my point now? So under asset, what do we find under asset? Under asset, set divided into what? Into non-current asset and current asset. Non-current asset and current asset. What if under non-current asset? Non-current assets. What do you find under it? You find, for example, land, building, premises. It's easy. These are the what? Non-current assets. Non-current assets is divided into what? Into tangible and intangible. The tangible are the land, building, premises, motor vehicle, equipment, whatever. You get the point now? Then you have intangible. These are the intangible. Tangible are what? Are goodwill, franchise, patent rights, internet. Those are the what? Those are the what? Those are the what? The intangible. Then under asset, we still have what? We have current asset. And what do you find under current asset? That's where you are going to see what? Inventories. You are going to see what? Receivables. Inventories are stock. Receivables are debtors. You are going to see cash. You are going to see bank. Do you see? Assets of stock are the what? Are the what we find in the balance sheet as what? As current assets. That is what turns into all this. Turn into sales account, purchase account. So about purchase account, assets of stock still cover one under liability. Find other liability, and that is what? That is current. You find under current liability. And what is that? That is creditor. It is the purchases. Those, as like I said, purchases are divided into what? Either on cash basis, or on credit basis. So it is the credit basis that we turn those goods that we bought that we have not is at the end of the year when we are going to make our financial accounting for the owners or the shareholders, whatever. So it is the one that have not paid that are turned into creditors. These are the assets of stock. Where do you find it? You find it under current assets and under current liabilities. That is the asset of stock. I'm giving the full scenario of what you call asset of stock today, and get it very right. Get it very well, very well. I don't think any textbook is going to explain this to you. But from this study, I've come to what to realize this. That there's something that's called what? Asset of stock. You can only find asset of, but it will not elaborate like this. So when you understand this, you will know what is called asset of stock. What am I saying? And what am I saying? That is, if you talk about assets, you have land building. Why are they not? They are not what? Assets of stock. All these are what? Are non-current assets. Land, building, premises, equipment, motor vehicle. All these are what? Are the assets that bring cash inflow into the business more than 1 year. Assets that bring cash inflow into the business within this period of 1 year. That is what we call what? Current asset. And they are the ones that turn to become assets of stock. Do you get the point? That the one that turns into asset of stock. Non-current assets. They are those assets that we purchase for the running of the business, but they bring cash inflow into the business more than 1 year. They are not asset of stock. We don't carry them to store. It is the one that we sell on day-to-day basis, on daily basis, that turns to what? To become what? Asset of stock. And they are current assets. They are receivables, or you call it receivable, or call it stock. Inventory, you call it inventory, or call it stock. Receivables, call it receivable, or call it what? Debtors. Then cash, bank, that's another current asset. Then you still find one. You find the remaining one under current liability, and that is what? Creditor. That is what? Creditor. All this that I've been doing is just introductory aspects. Like I said that today, we are covering purchases of stock on credit or on cash basis. So I'm rubbing this off now to go into the business of the day. And what is the business of the day? That is what? That is purchase of stock on credit or on cash basis. So I'm taking it one after the other. For today, we are covering purchases of stock. Maybe in our next video. So watch out for that. We're going to cover what? Purchase of stock on sales of stock on cash or on credit basis. Today, we are on what? Purchases of stock. Purchase of stock. Either on credit or on cash basis. Either on credit or on cash basis. Purchase of stock on credit or on cash basis. So the explanation that I've given is enough for you to know the meaning of what? Of asset of stock. So when you know it, the financial accounting will be very, very simple for you to understand as you advance. This is for the beginner. So today we are covering what? Or we are covering purchases of stock. Purchase of stock. So like I've said, purchases of stock, either it involves either cash or credit basis. So purchase of stock, purchases is either on what? On one, credit basis. Today whether is somehow we are going to just manage the video for us like that. It's raining in the morning and the weather is not so good for the video, just manage it. So we have, if it's credit basis, you have two accounts. If it's credit basis, you must have what? The purchase account and the buyer's account. That's the personal account. You have one, you have two accounts. You have purchases account. Then you have what? B, the buyer's account. Buyers or customers or customer. That you call what? You represent that with what? With the name, because he has not paid us. So you have, for example, assume it's Bola Olu account. So you have it like this. So when we purchase on credit, what happened? The asset of stock or purchases what? Increase. For example, let's assume it's what is 1,000 naira worth of goods that we purchase. So that means our purchase what has increased. For example, let's assume that on the 2023 or 2022, we have 500 naira as our BD, as our balance BD. So the meaning of what? Increase. That's another point that you must take note of. Increase means on the 1st of January 2022. And what happened? It just 500. But it now increased with another amount. Maybe on the 15th of January 2022, there's an additional. So we purchased goods from what? From Bola Olu. That's what? Bola Olu. For example, 1,000 naira. As it now increased, it has increased from 500 to what? That's what we mean by what? That's the terminology. It's increase. That's terminology. From 500 it has increased. Then you balance it off. Let's assume at the end of let's assume let's say balance, that means 31st December 2022, balance CD, balance carried down, is going to be what? 1,500. So 1,500. So it has increased. So what is the corresponding entry for this? Corresponding, because that is double entry for you. You are seeing on that double entry. A debit entry requires what? Is corresponding credit entry. It's corresponding credit entry. So what's corresponding entry here? It is what? It is Bola credit entry now with the same amount. And that is what? Purchases account. That is what? Purchases account. And that is what? 1,000 naira to Bola Olu's account. But for the business, this is what? This is purchase account. So this is what? This is purchase of stock on credit basis. On credit basis. Let me quickly go to purchase of stock on cash basis, because that is the business of the day. Purchase of stock on cash basis. Purchase of stock on cash basis. Purchase of stock on cash basis. This is the business of the day. Purchase of stock on what? On cash basis. So purchases of stock on cash basis. It's either on two ways too. One A. No. We just did Yes. This is on cash basis. We did on credit basis. Now on cash basis. It involves what? Two accounts also. Two accounts also. If it's on credit basis, it will involve purchase account and the what? And the buyer's account. Because he has not paid us. We must record his name. But if it's on cash basis, there's no need of recording what the buyer's names to have it also as what? As a whether dollar or risk account. No. He has paid us. The corresponding is going to be what? Cash account. So the first, and if it's on cash basis, the first account is going to be what? Purchases account. Purchases account, and what will be corresponding? That is a cash account. So, for example, let's assume that 1st of January again 2022, our balance BD. If it is the beginning, you have BD. At the end, you have CD. Beginning, you have BD. At the end, you have what? CD. Those are another terminology that you must understand. At the beginning is BD, balance BD. This BAL is what? Is allowed for balance. Then BD, brought down. Then carried down. Brought down, carried down. These are the terminology what? In accounts. So assuming our this is Nigerian naira sign, assuming is what? Is 400. Balance BD on the 1st of January. So we are still running. So for then as the time goes on, maybe on the 20 January 2022, we purchase on cash basis. So there's no need of what? Of recording the name of the what? Of the buyer because of cash basis. So we have what? Cash account. Let's assume that we purchase 800. So look at it. 1st of January, it is 400. This is the terminology what? Increase. It has increased to what? We bought additional. So it has increased to what? To 1,200 naira. So at the end of the year, when we are making presentation of what? Of financial statements, we have what? 31st 12 2022, we have our what? Our what? We have our balance CD to be what? To be, it has increased from 400 to what? To, we purchased another one, 800. It has increased from 400 to what? To 1,200. Then you close the account, 1,200. You close the account here also, 1,200. And whenever you are closing, you put two lines. Whenever you are adding two figures together, that's the balance for you. That's balance. You close it. Then, what is corresponding entry of this? This is what this is, cash account. Then you come here, you have what? Or, you have, that is on the 4th, but let's just leave the date now. Let's go to what, let's focus on what? On the corresponding entry, which is what? For corresponding entry for this is what? Is purchases. Purchases accounts. Then what do you have there? 800. For what? For the corresponding entry. And that's what we call double entry. 800. What's double entry? Double entry is what? Is the entry of what? Of a single transaction into double accounts with the same amount into two different accounts. Look at it. Purchases account, cash account. Into two different accounts. That's double entry. A debit entry must have its corresponding credit entry. So that is position of stock for you today. If you have been receiving any value from what we have been saying so far, from the lecture so far, do give us a what? A thumb up that you like this course and you want us to produce more. Now that shows that you are supporting us. You want us to continue to produce more. You are encouraging us to produce more. So that we can continue and do this always. And I've said it that what they are committed into this. That this channel is committed into adding value, that is regarding what? Financial accounting, financial accounting what? Courses. That is accounting courses. Like LV, we are still going to cover what? Others. Costing, auditing, tax, public sector, they are money. But they give us what? A support that you like us. Hit that red button also to show that what? You subscribe. Our channel needs what? Subscription. That is to subscribe to us. Please do subscribe and share it to your what? To your friends, to your student friends, so that we can be able to produce more of these in the future. And YouTube will be able to notify you. YouTube will notify you whenever we produce if you subscribe to our channel. So thank you for doing so. God bless you. See you in the next video.